Hi, this is RJ with rjloans.com, and I'm finishing up my last two letters of the acronym CCIP. We are now covering the I and the P. The I stands for income types, and the P stands for property types. So let's talk about income types. We're in the entire industry is all under a full doc environment. What does full doc mean when we're talking about income? We're talking about tax returns. We're talking about pay stubs. We're talking about P&Ls. We're talking about W-2s. All this is a source of documenting our income. And under all guidelines, we need to document the last 2 years of your income to average, showing what you make to make an educated decision on qualifying you for a loan. Now, I'm going to take the standard guidelines and say I'm going to stretch it a little bit, and I'm going to mix between FHA and conventional loans. For the most part, a 2-year history of who you are on your income is important to document. Now, not everybody has a full 2-year income history. You ask why or how? I'll give you an example. People who go to a 4-year college, who get degrees to do what they're planning to do, and as they jump out of college, they get a job offer. In that case, you've got a person who has a 4-year job history. That's right. All lenders can and will request a copy of transcripts, possible diploma, and a job offer letter. A job offer letter will be on letterhead from the employer to state the person's position, as well as their income and a start date. Most lenders will require you to have your first day on the job and will require you to have your first pay stub on your job in order to count the diploma, the transcripts, the job offer, the pay stub. There you go. That is one way of documenting your income. What are other ways? Well, there are some people that take part-time jobs for the past 2 years to get the full-time job, which they have, again, a job offer and a guarantee. Now, what does a guarantee mean? Well, in the loan business, we like to see salaries. That's right. Salaries are guarantees in our world. Commissions and 100% commission jobs and commission with bonus time and commission with bonus time and overtime, those don't look so favorable in terms of offering them guarantees. So when you're looking at a full doc loan and you don't have a 2-year history, the lender is going to frown upon trying to count anything that hasn't happened yet, such as bonuses and overtime. So make sure you know what you're getting yourself into in terms of documenting your income. Most lenders will count the salary, the job offer. And if you want to make it real simple, the simple guidelines of providing 2 years of history. That would require the last 2 years of W-2s, a most recent pay stub on the job. Now, that is the standard way of documenting anybody who has a W-2 job income in terms of documenting their source of income. Now, what are some variables amongst this? Well, there's people that change careers, they change jobs, they change income types. Just make sure you know, even though you're W-2'd and your salary and you have a pay stub, if you're writing off expenses and you know that you're doing it on your tax returns and on your schedules, your lender may require all schedules on your federal return. So when we're talking about full documentation loans, let me just give you a recap. A full doc income loan is going to require 2 years of tax returns, 2 years of W-2s, 1 month's worth of recent pay stubs. The combination of those are the standard documentation. I just talked about the variables of what could happen in terms of people in college or job changes and transfers. If you have 2 years in the same line of work and you are W-2'd and salary paid, it should be fine with minimum job gaps. You should be fine in terms of qualifying for the new loan. If there's large job gaps in time, or there's a large gap in difference in income or job position or career, again, documenting, the best thing you can do is document how it pertains to shedding your position in the best possible light. If it's an advancement, great. If it's a job offer, it's in a better position, better job, different city, great. Provide your lender with as much ammunition as you can to show the stability and growth, the growth curve of going up in your job and career. Now, what if you're self-employed? The same 2 years apply. You must supply your lender with the last 2 years' tax returns, and we're going to need all schedules, whether you're incorporated or just a standard S Corp, C Corp, or just your standard self-employed borrower, which is your Schedule C income. Beware, as you write off expenses, which is your God-given right on your tax returns, the net income is what the lender is going to use. So even though you may be claiming X amount of money as your gross amount, and you write it down to Y, the lender's got to use Y. And if Y is a lower number, unfortunately, we have to take an average. We got to average it 2 years. Yes, that's right. So let's just say you made $40,000 net income last year and $50,000 net income the year before. We're going to take the 50 and the 40. We're going to add it together. That's 90. Divide $90,000 of net income on a self-employed borrower, divided by 24 months. That's what creates your gross monthly income, otherwise known as GMI. So all the lender's trying to get to is to qualify you off of a monthly gross income. It's really easy to do for a salary employee because you look at the pay stubs, and it's really easy to do with a self-employed borrower. Take 2 tax returns, average the years, net income, less expenses, of course, and average that by 24 months. So the name of the game of the income, the I, is balancing the income to get an average. If there's job changes, show your lender. If there's promotions, show your lenders. If there's a traditional increase, bonuses, and overtime that's part of your new job, show your lender. If you're self-employed, no matter what, all schedules are provided. If you suddenly have changed in terms of your income revenue stream, again, the best you can do is provide 2 years tax returns, and if you're self-employed, a most recent P&L from your CPA accountant. That's like having a pay stub. Since you're not a salary employee and you're self-employed and you pay yourself, a P&L from your CPA would give you the most recent year-to-date P&L would be the pay stub in lieu of a pay stub. The P&L would be in lieu of a pay stub, is what I'm trying to say. So let's do a recap. The income. 2 years. Salary, W-2, easy to do. You're self-employed, all schedules. We're going to average, average, average. Job increases, prove it. The bottom line is, it's really easy to give all the information as long as you give it up front to your lender. That is the conclusion of the income category. Next off, we'll be talking about the property. I hope you enjoyed this. If you have any questions, don't hesitate to email me at rjloans@gmail.com. That's rjloans@gmail.com.